another couple seconds, and then we'll get going. Okay, I think we'll start off. It's 10:01. Good morning, everyone, on this kind of miserable day here in Halifax, at least wherever you're calling in from. Welcome, and welcome to today's Business Support Series webinar. Thanks everyone for joining us today. My name is Kent Roberts. I'm Vice President of Policy here at the Halifax Chamber and your host for this morning. As you know, the federal government has put several programs in place to support our business community and keep Canadians employed during the pandemic. This pandemic has forced us and businesses to move quickly, and many businesses prepared these calculations and applications without the benefit of a tax advisor. We want to ensure that our members who took advantage of the wage and rent subsidies have the opportunity to ask tax specialists their questions. So again, thank you to everyone who submitted questions to our presenters. And when we get to the Q&A and during the presentation, please feel free to type in any other questions into the chat box that you might have, and we'll do our best to get to all of them. So a big thank you to our speakers for joining us today, Greg Leslie and Laurie Messenger from Baker Tilly, Nova Scotia. Laurie is a tax manager who's focused on helping clients with their GST, HST, and other indirect tax needs. And since March 2020, has been a dedicated resource for all COVID-19 relief measures and programs at Baker Tilly. Greg has completed part 3 of the in-depth tax course and is a frequent lecturer for CPA Nova Scotia and CPA Canada, and has presented on income tax matters to a variety of local and regional business organizations. So thank you both, Greg and Laurie, for joining us, and welcome. At this point, I'll turn it over to Laurie and Greg and have them go through the presentation. And then, as I said, we'll open it up to questions. So please submit any question that comes to mind on the chat as you listen to Greg and Laurie. So thanks, Laurie. Over to you.
Thanks, Kent. So as you can see, title here is, are you ready for a CEWS or CERS rent subsidy audit? A few things that we want to focus on today would be just briefly on how the programs work, and then we want to run through some of the common problem areas that we've seen and that our clients have seen with doing calculations for these programs. Lots and lots of issues to cover, but we'll jump in with just a summary of how the programs work. So, you know, the intention of these programs was to provide assistance to businesses to continue keeping people on payroll where they've had a revenue decline, cover some of the employee wages, allow businesses to rehire. And, you know, we never would have imagined, looking back to last March, that the CEWS program would carry on before the initial 4-week periods. But as you're all aware, that changed pretty rapidly, and we're now looking at upwards of 16 periods by the time we get to the end of June 2021. And with the new rent subsidy being introduced effective with CEWS period 8 back in September to October. What frightens us a little bit, I think, is that the programs not only continue to evolve throughout this entire last year, but also they are still continuing to evolve. We're still seeing updates to the guidance that's available, the CRA's FAQ page, and how the programs work. So we've identified some problem areas and what we're calling the top 10 issues related to doing calculations and understanding these programs. We're going to try to run through them fairly quickly so that we can allow for lots of time for questions. And like Kent and Kayla mentioned, please do put your questions in the chat and we'll do our best to answer as many of them as time allows. So we'll jump right into the first issue, which is revenue comparisons for these programs. With the first 4 periods, there was a cliff that you needed to fall off with regards to revenue declines, and that 15% for March or 30% for April, May, and June. And since then, the revenue comparisons are what actually determines the base and top-up subsidies. So the issues with these revenue comparisons are that you normally be calculating revenues or comparing revenues under your normal accounting methods, a term that's not actually defined. So it doesn't mean cash basis. It doesn't mean accrual basis. It means, in my opinion, do what you've been doing in terms of revenue recognition, keep doing it consistently, and don't make any changes that will allow you to fall into qualifying for the CEWS. There are issues with understanding what can be excluded from the revenue comparisons. So extraordinary items, for example, can be excluded. Another phrase that was not defined, but the CRA have provided some guidance on their FAQ page to indicate that an extraordinary item really needs to be something that would only happen rarely, not frequently, not recurring, not in management's control. The COVID-19 relief programs are considered extraordinary and can be excluded, but otherwise you really need to look at every single situation to determine if you might have an extraordinary item. Timing of revenues is important as well. So there's been some misunderstanding early on, at least, as to what is the comparison. Are we looking at a full calendar month? Are we looking at a 4-week CEWS period? And so just a reminder that the revenues that we're comparing are a calendar month. So for example, period 5 of the CEWS program, you would be comparing July 2020 revenues to some other period, the normal period being July 2019. Interesting issue that's come up over the last few months is clients contacting us where they've actually either qualified or not qualified for the wage subsidy because of year-end adjustments that are made when financial statements are prepared or tax returns are prepared. And so, we see this as a bit of an issue, because if you have a year-end adjustment to a revenue account, it might not actually be related to that particular month. It might either relate to a specific point in time over the last year, or need to be spread out over the entire year. So I think when we're talking about the risk here in terms of revenue comparisons, we're always thinking about, with the CEWS program, the risk is, that CRA comes to town and audits you and reviews your calculations. And so when it comes to the revenue comparisons, the risk is that they might disagree with how you've either calculated or compared your revenues. So we think, documentation is key in having support for whatever you've done. And sadly, there are a lot of businesses out there, at least for the first few periods of the program, that had no documentation of what the revenue comparisons were, or nothing saved that was specific to the CEWS applications, because you don't need to submit them when you make an application. And so, perhaps businesses were basing their decision to apply for CEWS on sales figures that they had in hand at the time, or gut instinct, or knowing that their revenues were down. But you do actually need to have support when it comes to the CRA audit. Greg, do you want to add anything in there about the revenues?
Sure. I think, we're identifying the top 10 calculation issues here, and calculation issues become audit issues. And I think that's the whole point of the morning. And there's a few specific areas where the risk can be accentuated. One thing I think of is, for smaller businesses with smaller revenue amounts, if you have a small business like that with a modest revenue base that just barely squeaks into qualification, the risk, I think, in absolute dollars is lower. It could just take one misplaced invoice to change the math for you on something like that. Where you've got bigger organizations with hundreds of thousands or millions of dollars of revenue a month, then the actual absolute dollars that would have to swing your math might not be as large. But for most chamber members and most of our clients who are small and medium-sized business, I think the risk there is accentuated. And I'd mention also, there are some areas in here where we are forced to use judgment, where a hard and fast rule doesn't apply. So, the idea is to consistently use your judgment calls throughout each month as you're determining what your revenues are. I think of that, extraordinary items as one example. in determining what's extraordinary and what's not. I mean, interestingly, one of the things that CRA is telling us should exist for an item to be extraordinary is it should be primarily out of the control of the management of the company, whether you receive it or not. Well, just about everything is within your control one way or the other, unless, it's a windfall or pennies from heaven, or, maybe an insurance claim or something like that. So there is some judgment, in determining what's extraordinary and thus should be included or not. I think it's important, though, if you exclude an item from your prior reference period, then you should include it or exclude it in your prior reference period. You should include or exclude it consistently throughout the subsequent months as well. And, just a few other things that can get you trapped up here and what to include or exclude from revenue. Things like revenue from arm's length sources that you have to exclude and exclude consistently. Income or revenue from Canadian sources from business activities conducted in Canada is all that counts here too. So being careful to exclude revenue earned from outside of Canada consistently throughout all your periods becomes important. And then, there's just errors. Small businesses make errors in their accounting, which could skew the results. And although, we are told to use normal accounting methods, I don't think we could, and I say this only half joking, I don't think you could argue with CRA that, making material errors is part of our normal accounting methodology. So, having enough wiggle room within your math to account for those errors, I think becomes important.
Yes, it's interesting that you say that, the lower the revenues are, the lower the risk might be of being selected for audit, but also the lower the margin of error if you've got any mistakes happening in there. Our plan would be to hold off on answering questions until the end, but I did see an interesting question pop up that's directly related to revenue comparisons. So maybe I'll just address it now, whether or not we should be including realized or unrealized gains on foreign exchange. It's one of those things that's been debated over time. It is clear to me that investment income gets included in the revenue calculations for CEWS in terms of regularly occurring interest and dividends. And I think when we're talking about foreign exchange gains and losses, well then my thinking would be, look to what is your normal accounting method. Are you recognizing them regularly and consistently throughout the year? And if so, you should include them. What do you think, Greg?
It all comes down to doing what you did before consistently with your past practice on that. That's my view.
So issue number 2, oops, sorry. Clearly I'm clicking a few too many. My apologies there. So issue number 2 is all of the different revenue related elections. We're going to hone in on the ones that we've seen the most often, but there are several elections that can be made when it comes to doing the revenue comparisons. The most common one that we've seen is an election to compare the current year to either the normal, which would be the same month prior year, or the election to compare to the average of January and February 2020. And so that is an election that is available, that a lot of businesses have made for a variety of reasons. Another would be electing out of whatever your normal accounting methods are and into either strictly cash basis or accrual basis. Finally, we have seen a lot, or a few, I guess, businesses where comparing revenues for an entire affiliated group is more beneficial or perhaps less risky than comparing revenues on an individual entity basis. Greg, can I get you to just jump in and add some comments to what that affiliated group would look like in terms of how that's defined?
Right. So affiliated is a tax term, a defined tax term that describes a relationship between parties, and for our purposes, specifically between companies. And it's probably the narrowest such definition in the Income Tax Act. If I put it simply, basically two companies are affiliated with each other if they are subject to common control by the same person or by the same couple of spouses. So it's, a closely controlled group of companies owned by the same married couple. Companies owned by other family members, brothers, sisters, parents would be excluded from that affiliated group. So that's what makes it a bit narrower than perhaps other definitions.
And I think the issue there is misunderstanding the term affiliated group and assuming that it would be the same as associated or related, which it is not. It's a much more narrow term, but also misunderstanding that if you are going to make an election, a joint election for affiliated groups, that it captures every single entity that is affiliated. And so you can't exclude holding companies, for example, or other, real estate holding companies, things like that. If you're part of an affiliated group, you're part of this election, and therefore all of your revenues need to be considered as well.
I think just on elections in general, the making of an election with CRA can kind of become audit bait. Generally when there's dozens of different tax elections in our income tax rules, and they require you to fill out a pre-filled form or write a letter to CRA, sign it, and send it in. And it's basically saying, hey, CRA, we've done something here. We're filing an election on it. Usually it's an election to our tax benefit. So you do kind of wave a red flag in front of CRA whenever you file such an election with CRA. We'll come back to this point a little bit later, but the making of these elections is really just the ticking of a box on the application form for the wage subsidy. So maybe it's not as blatant a red flag in CRA's eyes, but nonetheless, we are identifying the elections that we've made, so that that can trigger what we'd call selection risk in an audit, which is the risk that you draw audit attention in the first place.
And the checking of that box is informing CRA that you've made an election, whether it's on the attestation form that is signed, which we will talk about a bit later, or through the application process. But an election itself is a separate document. In this case, not a prescribed form, but a separate document that would be normally signed by the directors. So something that is swearing to having made a particular election.
And the making of a couple of these elections here can really result in some favorable results for the claimants. I think of electing to calculate your revenues using the cash method instead of your normal method or the accrual method, and electing your prior reference period to be an average of last January and February's revenues. So if you do both of those at once, and we've seen it, you might get in a situation where somebody had really good cash receipts in either January or February, which you want those revenues in those months to be high because those are the months that you're comparing all the subsequent months to. So if you had a spike in receipts in one of those months, that can work out to be really favorable math to you. So even though now we could be getting to the end of your fiscal year and you look at your top line revenues and say, hey, they're not so bad after all. During all this year, we really didn't have a big revenue decline overall this year, but we almost qualified for the wage subsidy out of luck just because we had these big lumpy collections in the right months. And again, I think that's the type of thing that can draw audit attention from CRA too, when they look at a company that had actually a pretty good year, yet qualified for thousands and thousands of dollars of CEWS through the year, just by the simple fluke of math and how it worked out for them. So I think it increases your risk of getting audited in the first place, which certainly increases the requirement to make sure that all ducks were in a row in the first place.
Well, in the number of situations where we've seen that those two elections in particular are making the difference between qualifying or not qualifying. And when you consider the intent of the program, businesses are suffering and would expect to qualify, and these elections are another way to fit into a program that's intended for just that. So
right.
considering
I mean, that's why they're there they're there to widen the pool for more people to qualify. So it's completely on the up and up.
Yeah.
It's just sometimes appearances are something you have to be concerned about. I think also it's a good look in making those elections if you make these choices, and maybe there's some judgments involved in how you calculate your revenues. If you say, well, look, our choices really worked for us for, say, April, May, and June, but as a result of our choices, we didn't qualify in July. Sitting across the table from a CRA auditor, if you're able to kind of say, look, we just let the chips fall where they may, based on the choice we originally made, and sometimes it worked, and maybe there was occasions or months where it didn't work out so well for us. I think that's a good look for taxpayers when they're sitting across the table from that auditor.
Yeah, it's an
We're there.
important point too, that it's once you've made some of these elections, you're locked into them for a set number of periods. And so the cash or accrual basis election, for example, if you made that election at period 1, you are stuck with it for the entire program. You can't go back and change your mind, or at least not easily. And the prior period reference, for example, that if you elect to use the January-February 2020 average, or fail to elect to do so at period 5, you're stuck with that decision. And sadly, yesterday was the deadline to make changes to period 1 through 5. So whatever decision you've made, you're kind of stuck with it. So issue 3 is the subsidy rates. And they're I won't say too much on this personally, but basically period 1 through 4 were the locked in 75%, you got it or you didn't. And period 5 and 6 were potentially going to still get 75% if you fell under the safe harbor provision or one of the deeming provisions. And beyond that, period 5 onward would be a subsidy rate that is based on your revenue decline and made up of two parts, a base subsidy and a top up. The calculation is essentially the same, whether it's the wage subsidy or the rent subsidy. And I think when we speak to risk here, again, it's all about what is the CRA auditor sitting next to you going to be looking at? They're going to be looking at how you made the calculations. Did you use one of their calculators or spreadsheets to do it? Are there any errors in the revenue numbers that have been used? Not much more to say really about subsidy rates. I do recommend using the CRA spreadsheets as a way of testing and calculating your subsidy rates. I caution you though to make sure you're using the most recent version. Just as an example, period 1 through 4 made it all the way up to version 11, and a lot of calculations that were done with version number 4 or earlier, the ones that we would have been using early on, actually did have formula errors that in some cases would made a very big difference. So just to be careful with how you're calculating these subsidy rates. So this concept, issue number 4 of baseline remuneration, also known as average pre-crisis remuneration. The biggest issue that we've seen here is that people are calculating it based on pay periods dates, not paycheck dates, but it's actually based on when the wages are paid. So for example, the normal baseline period, January 1st to March 15th, you would be taking paychecks paid within that period and averaging them over the number of weeks that they covered, excluding any for any employees with 7 or more consecutive days off. So what that could mean, if you had a paycheck on January 2nd, 2020, that really relates to the entire pay period from December of 2019, you're still including it in the baseline calculation because it was paid in 2020. And on the other end of that range, if you had a paycheck on March 20th that related to a period before March 15th, you shouldn't be including it in the baseline calculation. So I think that has been the biggest issue that I've seen. And then the next biggest issue has been people not being aware of the optional baseline periods that got introduced in the summer, or not looking back to see if using those options might have been beneficial. They could only have been beneficial. So if you did calculate an optional baseline period, which differed depending on which period of the CEWS you were in, you could actually, in some cases, end up getting more subsidy. This is most important when it comes to non-arm's length employees who are restricted in terms of the amount of CEWS that you can get. It's based on that baseline average, but also you could get extra subsidy in the first 4 periods for arm's length employees, depending on their baseline. And so you might have a beneficial, the higher the baseline average, the better. It could have resulted in getting up to 100% of their wages subsidized. So those are the issues from my perspective. Greg, do you want to add anything in there?
No, that's good. Let's continue on in the interest of time.
Next topic, next issue, number 5, is the eligible remuneration. So this would be the pay that is occurring during the CEWS period, completely the opposite of the baseline. It's actually based on when the wages are earned, not the specific date that they've been paid, although they do have to have been paid in order to make the CEWS application. But you really need to go to the pay periods, the hours worked. If you don't have salaries employee, you need to remember that a CEWS week runs from Sunday to Saturday, and there's 4 weeks in each period. So if your payroll does not run from Sunday to Saturday, you're going to have to do manual calculations where things don't line up. You also have to be aware that from period 1 to 4, and this was actually one of the formula errors in the earlier CRA spreadsheets, if you had an employee with 14 or more consecutive days off, they do not qualify for CEWS in periods 1 through 4. So a lot of manual calculations needed. The CRA's FAQ page eventually did include a lot of examples on how to do this. So I would always tell people to refer to that FAQ page for sure. There's also been a lot of misunderstanding in terms of what extra subsidies were available for furloughed employees or employees on leave with pay. And so this would come up during the application process itself, where you would have boxes that indicate that you can enter in the employer's share of the EI and CPP, but only if you had employees or for employees who were off work and still being paid. And then finally, an issue, and it's, I think the risk here gets higher as every day goes by, but it's the consideration of whether or not you can retroactively pay people back into a CEWS period. And so it is actually possible to pay people retroactively, whether they were working or not. But I think the farther away we get from the earlier periods, the more uncomfortable I get with retroactive pay. Greg, do you want to add anything in there?
Just that, some businesses kind of get lucky and their pay periods line up exactly to what CRA has spelled out for us, and the calculation becomes somewhat simplified. But we've certainly have seen a lot of calculations or reconciliations that really end up being a dog's breakfast, a pretty complicated reconciliation. So I think the point is, there's more room for error there. More important that you have your process or your calculation documented and presentable in some way that you can explain it to a CRA auditor as well. I might just at this point make a quick note about the CERB as well. You'd recall the CERB was the $2,000 a month benefit that was available early on to employees who found themselves out of work. And there is a provision that requires, in certain circumstances, employees to repay any CERB that they received, half if they did, in fact, return to work. So where employees were let go and then rehired, and perhaps CEWS claims were made with respect to their wages, those employees could find themselves in a situation where they have to repay that $2,000 for that particular month. As employers, it's not really your problem, it's your employees' problem. But to the extent that employees' problems are employers' problems too, I think it just bears repeating here.
Thanks. Lots and lots of issues when you have employees with variable pay. So that would be anybody who's not on salary, including hourly pay, including bonuses, vacation pay, commissions. There are some examples on the CRA FAQ page, but bear in mind they might not mirror your exact situations. So just thinking about that baseline option that applies to the current periods. If you're looking at wages paid between July 1st and December 31st, 2019, you might have some rather large and significant bonuses being paid at the end of the year. that might be for non-arm's length employees who wouldn't otherwise be on payroll. And so the question is, how do we properly allocate something like a large bonus to a pay period? Do we assign it to a particular week? Do we assign it to an entire 26-week baseline period? Do we assign it or allocate it over the course of an entire year? And our belief is that it depends. You need to really look at the facts of the situation that you're in. You need to consider, the rule, which is when were the amounts earned, and you need to make sure that whatever allocation you make is reasonable and justifiable. You need to be able to support it if CRA is asking questions. And so it may, in some cases, be reasonable to allocate an amount to a particular day on the calendar, like a commission, for example. If you have employees earning commissions that are dependent on a deal or a sale closing, well, then perhaps that commission gets assigned to a day, and that day falls in a particular week for CEWS. Or you might have something like an annual bonus that is paid every year in June that really relates to performance over the previous 12 months. And so perhaps you should be dividing that bonus by 52 weeks and allocating it that way. It really does just depend on the situation and how you can, justify and support whatever position you're taking, and also, whatever that position is, being consistent with it. Greg, anything you want to add in there?
Oddly enough, among our top 10 issues here, what you don't see is the actual calculation of the subsidy itself. How much money are we going to get at the end of every month? And I think the reason for that is, aside from a couple of the early hiccups that Lori mentioned, the spreadsheet that CRA provides for us, which is downloadable from their website, is actually pretty good and pretty reliable. What we're really talking about are the inputs into that spreadsheet. And the output of that spreadsheet is the actual amount of subsidy that you're going to get every month. If the inputs are good, then the output's generally going to be pretty good. I wouldn't quite go so far as to say it's fail-safe, but it's pretty close to it.
Perhaps not a huge issue, but one that when it does come up is complicated is whether or not the employer is actually the company that is doing the payroll. And so we've seen situations where there is perhaps a payroll service provider with its own payroll account number, or a cost share arrangement or agreement that has its own joint partner payroll account number. But not in neither of those situations is the business or the entity with the payroll account number actually the employer. And so without some maneuvering around and doing, some special things, those entities with the payroll account number don't qualify for the CEWS. And in some cases, the actual employer doesn't even have a payroll account number, so they can't apply for the CEWS. And so there is a process to rectify this. I think the process is, in a little bit in flux, depending on the situation, but there's basically, for a payroll service provider, there was a need to contact CRA to transfer payroll account balances from the payroll service provider to the actual employer, setting up a new account, which causes issues because if you didn't have a payroll account before May 15th, 2020, you couldn't apply for CEWS. And so then there needs to be a correction made by CRA to an error code that gets generated. And this process is a little bit in flux. We've seen some changes to it over the last few weeks with regards to cost share arrangements where you don't actually have to transfer the account balances, but you still have to jump through the hoops of getting approval from CRA to apply for CEWS under the actual employer. So when these situations come up, they're a little tricky and they do require a bit of time to resolve. I wouldn't say that they're necessarily a common issue, but they're definitely an issue when they arise. And I think the risk here is in not understanding the provisions surrounding payroll service providers. We're we're hoping it doesn't happen too often, but it's possible that payroll service providers or cost share arrangements have actually made applications for the CEWS and are later determined not to qualify. And going back to fix that could be tricky, particularly if they are a payroll service provider for multiple employers, and there's some fine tuning in the revenue decline calculations, subsidy rates, and payroll amounts for each employer. So the remaining issues are all surrounding the nice new rent subsidy program that came out in September, October, and lots and lots of issues. I'm sure there are issues with this program that we're not even aware of just yet. Not a lot of applications going in from my perspective just yet, but I think it's because of some of the issues and commonly misunderstood parts. And so when we're talking about the rent subsidy for tenants, as long as they are at arm's length from their landlord, the amounts that can be included for the subsidy according to the legislation are rent and amounts that would be required to be paid under a net lease, which might include operating expenses like insurance, utilities, and common area maintenance expenses, property and similar taxes, and other ancillary services that would often be supplied under a lease, let's say snow removal or something like that. Some things specifically excluded, but not by naming them, just by including a provision that says discrete items and special services. And we've learned through the CRA's website that things like, for example, leasehold improvements or tenant inducements would be, or tenant insurance would be among those special items. For owners, I think for people who own their own building and operate their business out of it, I think the misunderstanding is that all of the same things can be included as eligible expenses, when in fact the legislation limits it to three things: mortgage interest, insurance, and property and similar taxes. And so not 100% clear. And I think there's a lot of businesses that are assuming that regardless of whether they are a tenant or an owner, regardless of whether they have a net lease or not, that operating expenses like utilities and maintenance can always be included. So be careful there. These eligible expenses as defined in the legislation are a little bit different than what you might expect. And then, of course, the issue of whether or not you've paid it yet, or whether it's payable within 60 days. If you think about something like insurance that, was paid in the past, well, there's a question as to whether or not that can be allocated into a particular period when the payment occurred, let's say in early 2020. And then the whole concept of a net lease, or this phrase that's not defined, common area maintenance. I think, the net lease is one that would include as part of the lease something like a base rent or other rent, based on other calculations, and specific operating expenses that are the responsibility of the tenant, such as insurance, utilities, and common area maintenance expenses. If those things aren't listed specifically in your lease, then you should not be claiming them as eligible expenses. And common area maintenance, if you think about that phrase, well, that doesn't mean all maintenance. It means maintenance on common areas. Again, not defined and not necessarily 100% clear, but be careful. Be careful with that. I think the risk is that we're going to see a lot of audit activity on the rent subsidy where expenses that have been claimed are not actually eligible. Greg, do you want to add anything there?
I might add just that the eligibility or qualification for the CERS is based on the same revenue decline tests as the CEWS. So as far as calculation risk and audit risk goes, all the same revenue related concerns that we mentioned earlier for the CEWS also would apply as calculation issues and potential audit risk for the CERS as well.
And I'll just, I see a question here. I think if I click on answer live, I can go ahead and answer. So John has asked, if for items paid under a net lease, does it need to be amounts paid to the landlord? And the answer is no. It can be amounts paid to a third party, but the key is that it has to be included under a net lease, and so specifically listed in the lease agreement. Issue 9 with the rent subsidy is related, and a couple of these things mentioned previously, but whether or not you are a tenant in the property or an owner of the property. And so just, a reminder that a qualifying property is the real or removable property that is owned or rented and used in the course of the ordinary activities of the business. So your personal residence can't be included, for example, in the rent subsidy application. And just again, to reiterate, for tenants, expenses only can be claimed if they're under a net lease. And for owners, you have to be aware and careful that you can't include rent from any non-arm's length tenants. And those 3 limitations on the expenses for owners, which would be mortgage interest, insurance, and property taxes. The rent subsidy also has some interesting rules when it comes to non-arm's length tenants and affiliated entities. And so, the issues that we are seeing is not being fully aware that there is a limit per business location, a limit per period of 75,000 per location, or 300,000 in total for the base subsidy for all locations, including amounts claimed by affiliated entities. And so when you do the application online, you're asked to identify how that maximum 300,000 has been allocated under an agreement with all of the affiliated entities. And our concern is that people might be breezing through past that question and not giving consideration to the fact that that needs to be disclosed. And then when it comes to non-arm's length situations, just again, can't claim rent if your tenant is if you are a tenant who is not at arm's length, you can't claim rent. And similarly, the landlord cannot claim it either. Greg, anything you want to add on the rent subsidy program?
Another point about affiliated entities from a risk perspective. We already kind of described what affiliated companies are. I mean, you could have 2 companies that operate, pretty separately from each other. You might have, I might have a company of my own, and my daughter might have a company of her own, and we both operate them separately and independently of each other. But if I own both those companies, they're affiliated with each other because it's based on ownership, not on who's doing the work. So whether we know it or not, we have affiliated companies, and the math for affiliated entities would have to be taken into consideration for these CEWS claims or CERS claims. So, I think it's important to understand your corporate structure and to understand what other companies in your corporate structure are doing as you get into these claims to reduce your audit risk later on.
For sure. So how is CRA going to audit these programs? I mean, the reality is we don't know. We haven't seen a lot of activity aside from some pre-claim reviews that have occurred, and those have tended to occur mainly by phone. By the looks of the sample audit letters that we've seen from CRA, it looks very similar to a payroll or a GST HST audit. The sample letters that have floated around on social media are very extensive, long lists, multiple pages worth of items that the CRA might request, things like bank statements and payroll information, obviously revenue information, income statements, but also a lot of other information that you might not think relates directly to your rent subsidy or wage subsidy calculations. And so I think, our understanding is that each CRA auditor will be able to tailor the list of items that they're requesting from you. But in the event that you receive a review or audit letter from CRA that has a very lengthy list of items, my recommendation would be talk to the auditor to ensure that everything they're asking for is actually needed. The pre-claim reviews seem to have been surrounding either very large claims or large claims per period, or claims where there's variability in terms of the amount of CEWS or subsidy that's being received each period, so where things are fluctuating and going up and down, or where the information included in the application doesn't necessarily match information that CRA might already have access to. So for example, the number of employees could be compared to the number of employees for whom T4s were issued in 2019, just as one example. But I think there's quite a long list of items that CRA might be asking for, and that the best approach would be to talk to the auditor before you start gathering up everything on that list.
So generally also in the audit process, if you're at loggerheads with CRA, the things that we look to are first and foremost is the relevant tax legislation. Secondly, we can also look at historical CRA policy pronouncements that they've made in any number of different CRA publications in the past about that particular legislation. And those kind of fill in the gaps or the holes interpretation-wise in the legislation. And finally, we can also look at relevant tax court decisions that set precedent as to which way a particular tax item might go. That's where we have some legislative history to deal with. In our case here, dealing with these subsidies, we don't have any CRA or very little CRA pronouncements because we don't have the history and we don't have tax court cases. So all we really have to rely on is the legislation itself, which was very quickly and sometimes haphazardly thrown together, and some background or information that CRAs publish too, which frankly sometimes contradicts the letter of the law in the legislation. And to that point, CRA is trying to figure this all out at the same time that we are. It's as new to them as it is to us. So I don't often have a lot of sympathy for our friends at CRA, but in this case, there is an aspect of sort of being in it together. And we've had discussions with people at CRA and people at finance. And I think maybe the theme that runs through it is consistency of your accounting procedures, reasonableness, and sound judgment in any areas where there might be gray areas. And so fingers crossed that attitude will persist throughout the audit process. I might add as well, Lori mentioned about a few pre-claim reviews that we've seen. CRA generally can audit in one of two ways. One is to do a pre-assessment review, which means before you get your check, they review your application. The other way is post-assessment, meaning they send checks and ask questions later. And that's probably going to be the case for most small and medium-sized businesses, is that any audit disputes are going to arise after you've already received your subsidies and spent the money.
Yeah, I think I agree with that completely. So preparing for an audit, well, get your ducks in a row, make sure you've got documentation and support. Read those attestation forms carefully. Make sure you understand, the boxes that you're checking, and ensure that whatever decisions you're making are reasonable, justifiable, documented. I'd also suggest checking for changes and updated guidance. The CEWS and CERS websites that CRA has put out there are several of them, but they are being updated regularly, still being updated regularly. And so, it doesn't hurt to have a glance at how things are changing as each period passes us by. And of course, talk to your tax advisor, talk to your accountant, and ask them any questions that you have. For me, I think that's it. Greg, do you want to add anything there before we jump to questions?
That's good. I think let's get to some questions. I see a few here popping up.
Great. Kent?
Great. Thank you, guys. Lori and Greg, really appreciate the time and the thoroughness of that presentation. I know I certainly learned a lot, probably a lot more than I want to know. That's why I have an account. But let's jump to questions because there are a bunch and I want to try and get through as many as we can. So I'll start right at the top here. Can we confirm that operating grants for non-profit organizations are not applicable to revenue? It was our understanding that they were not required as long as we remain consistent throughout our calculations.
Yeah, so I think the ability to include or exclude grant revenues is a really specific provision. And so it would be an election that is made to exclude government grants. And yes, you would want to do that consistently. It's not an automatic. It is a choice and an election that you have to make to whether or not you include them or exclude them.
And I think that's specific just to government funding too. There's certainly other
Correct.
sources of grants as well, but the election is specific or exclusive to government funding.
That's right.
Okay, thanks, guys. Another question. Just jumped. Oh, there we go. Okay. And this person says, I may have missed this. In March, we will be a year since the economy was affected by COVID-19. Will we continue to compare revenues to the previous year? Comparing March 2020 to 2021 will show much of a variance, yet we are still in the grip of COVID-19. I would expect we should compare March 2021 revenues to March 2019.
Yeah, we really hope that that turns out to be true. Right now, we have guidance up to the end of period 13, which would indicate that you're still comparing, based on the known comparisons that we've done. But beyond that, it's not 100% clear, and we're hoping for the same thing. It doesn't really make sense to compare March 2021 to March 2020. I haven't personally seen anything, as of, let's say, about a week ago that tells me one way or the other just yet, but I imagine by the time we get to period or get closer to period 14, we'll have more information about that. Greg, have you heard anything to indicate one way
Still
or
waiting.
another?
Still
Yeah.
waiting on that one. Yeah.
Yeah. Okay. I mean, I think that's a pretty common question. People are obviously waiting and wondering what the heck the comparison is going to be.
Yeah.
Okay. With regard to annual bonus, and I know you talked about this, if annual bonus is paid January 2021 and is related to Jan to December 2020, should the full amount of bonus be included in the January salary? Cannot go back at this time to allocate over 2020. Bonus not approved until 2021.
Yeah, so I love that question because it kind of points out the two extremes when it comes to making a reasonable allocation of a bonus. So you've got an annual bonus, it's paid in 2021, and we decided to give a bonus in January 2021. Does that mean that that entire bonus should be allocated to 1 week of the CEWS in January 2021? Maybe it does. Maybe that is reasonable and supportable and justifiable. It's also equally possible that it relates to the entirety of 2020, if it's based on 2020 performance, and could be equally reasonable to allocate it in that way, which makes it impossible to get it into CEWS for anything period 1 through 5, because the deadline has gone by. You can still do upward amendments to the subsequent period 6 onward, but maybe a different way of looking at it is if you have a bonus in January 2021 and you allocate it to one pay period, you're likely going to max out all of the employees who got a bonus for that week for CEWS. And so perhaps from a CRA auditor's perspective, it's reasonable, it's justifiable, and it's not harmful because you're not really going to get that much extra anyway. But I think it can go either way, and I think that there's reasonable allocations in between. Hate to say it depends, and there's no clear answer. I think there are, the CRA FAQ page does have some examples like this, but again, it's very fact specific, very fact dependent, and you want to, come up with a reasonable allocation and be consistent with it.
Okay, great. Greg, you look like you wanted to add something there, but.
Well, let's continue on.
Okay, good. Another question, for items paid under net lease, does it need to be amounts paid to the landlord only, or does it include amounts required to be paid as per the lease, whether to the landlord or not? You may have answered
Yes.
that.
Yeah, so as long as the amounts are, as long as the, expenses are clearly defined under a net lease, it can be payments to the landlord or to a specified, well, to a third party. The key is that it's included in the net lease.
Okay, and a question that stays in that vein, does the lease amount need to be cash paid to the landlord or amount expensed in FS if total lease is amortized over the lease term?
I just have to think about how that's worded. Does the lease amount need to be the cash paid or the amount expensed if the total lease is amortized over the lease term. Well, if I go to the legislation, or if I go to the guidance that we've seen, it's telling me that we need to have amounts paid or payable within 60 days of the period. And so this is implying that we've got an amount that hasn't been paid, that's just being amortized. And so I think that's perhaps maybe it's a bit of a gray area, but I think it's like I would proceed with caution there, because paid or payable is something that we have seen some guidance on, and paid or
Yeah.
payable within the specific 4-week period.
Yeah, when tax legislation refers to amount being paid or payable, it's usually deliberate and a reason behind it.
Okay, great. Thanks, guys. Another question: if we note affiliated companies for CERS, does it also apply to CEWS? Will it affect us for anything else with CRA?
Yeah, if you've made an election to calculate your revenue decline as an affiliated group, it applies to both. So that election is electing for revenue comparison for the affiliated group, and my understanding is that it would apply to both. Although there is a separate attestation form for each, but I think I'm not sure why you would do it one way for the rent subsidy and a different way for the wage subsidy. I'll stick with my understanding is that it would apply to both.
Yeah. Okay. Thank you. I mean, I know there's obviously gray in a lot of this stuff as you guys work through and as CRA works through it as well.
Yeah.
The last slide said boxes checked on attestation form is not election. Can you please elaborate on that?
This might be getting into kind of tax nerd stuff, but you know, an election is generally a prescribed form that you fill out, sign, and send in, or an absence of a prescribed form that's been designed by CRA already. It's a request or a letter in writing that you send into CRA. And when we look at a box on a form, it makes us ask ourselves, well, is that really an election? We're advising on that form, we're advising CRA that we've made an election. But I think the question is, have we actually made an election just by checking that box, or is there something else that we're supposed to do?
Mm-hmm.
There's no other prescribed forms like there is for many other elections. So I think the question is, well, is there something else we're supposed to do? Are we supposed to document that election, write a letter and send it to CRA, or write a letter and keep it in our files if CRA asks for it? I don't know if anybody's actually doing anything other than checking the boxes, but I think that's the point we were trying to make. And again, maybe it's the type of thing that only the tax nerds really worry about.
Yeah, I think for me, the concern was that the the CRA might request a copy of the attestation form and separately might request a copy of the election. And so my thoughts are that if there are two separate items that could be delivered to CRA in an audit, an election to me would be something that is put in writing, that is, signed by the directors and potentially sent to CRA. And an attestation is simply swearing to the fact that you've done something. And so when we check a box on the attestation form, we are disclosing that an election has been made, but is it actually an election in and of itself? So just be careful, if CRA is asking for a copy of the election, they don't necessarily mean the attestation form.
Okay, great. And I'll just stop for 1 second and say that we pride ourselves on being on time for these webinars, and we're about up on time exactly to 11 o'clock. But if you guys are willing to stay on for a few more minutes, and people want to stay on for a few minutes, I'd like to ask a few more questions. If
we're good.
Yep.
Because I mean, I think they're good questions and they're important questions, and I think people are getting value out of the answers. So I'll try and get through all of them if we can, and then we can sign off. So if people are willing to stay on, please stay on, and we'll ask a couple more questions. So where was I? Let me see. So this is an easy question. Can these slides be made available to the attendee? So we do record these and they're on our website, but if I'll ask you guys if you want to make the slides available, we can send them out to attendees.
It's fine by me.
No problem here.
Okay. Please, can you review the requirement to include or exclude investment-related income in the revenue calculation for CEWS, i.e. dividends, interest, capital expenses, gains and losses, unrealized gains and losses, etc.?
Yeah, I think maybe the best way to address that is just to look at a couple of things. So first of all, normal accounting method would be one of them. How do you normally account for things like investment revenue, like interest, dividends, capital gains, losses, unrealized gains and losses, but also just looking at, what the definition, just flipping to it now, sorry, of qualifying revenue says. And so it indicates that qualifying revenue means the inflow of cash, receivables, and other consideration arising in the course of ordinary activities of the eligible entity. So if you think about what your ordinary activities are, if you are ordinarily holding investments and earning investment income revenues, then that is a part of your ordinary activities and probably your normal accounting method. The next part of the definition says generally from the sale of goods, rendering of services and use by others of resources in Canada. So, how does that tie to investment revenue? I guess, these are resources that are being used by the entity.
Yeah, I mean, I would think if it's income from portfolio investments, again, CRA here says, to the extent that investment revenue arises in the course of an ordinary activity. Well, if you're a portfolio investor, I'd say that's an ordinary activity.
Yeah.
Unless it's an extraordinary item or on account of capital. So, perhaps an unusual capital gain from a one-time disposition may be extraordinary. Again, back to that test where it has to be outside of the control of management, which you'd think something like that would be. But something unusual and lumpy like that, you might be able to exclude, but anything regular and predictable would be included.
Yeah, I've had people ask if it's, doesn't it exclude capital gains? And I would say similarly, if it's portfolio investments and you have regularly occurring capital gains on those accounts, well, then that is in the course of ordinary activity and should be included.
That's what you're doing. So it's ordinary and included. Yeah.
Great, thank you guys. So a couple of people asked this question regarding summer students. I had a summer student which I received a Canada Summer Jobs grant for. Excuse me, when calculating my CEWS subsidy, do I include or exclude the student wages in my calculations, or should I only include the portion of the wages not covered by the grant?
I love that question. I love that question for a few reasons, because it gives me a bit of a stomach ache when I think about it. I don't love that part, but it does make us ponder. So, the CEWS program itself does not appear to be excluding other subsidies or grants that might be available. The other grants and programs that might be available are definitely revising their agreements to specifically exclude CEWS. So, or the inclusion of wages on which you would have received or could receive the CEWS. And so I think that it's important to understand the agreement that you have. So Canada Summer Jobs Grant, for example, I'm fairly certain it specifically mentions CEWS in the agreements now. So make sure you're reading the agreement that you have for those grants. There are some grant and subsidy programs out there that, appear as if it would be perfectly acceptable to be getting more than 100% of your wages subsidized through two different programs. And that gives me a stomach ache. Personally, I wouldn't be comfortable with that, but I think it's a decision. I don't know. My advice would be don't double dip, but it's not clear that there are rules that are going to prevent this. And again, until we see the CEWS program getting audited, right now there's nothing to indicate that you couldn't be getting multiple, wage subsidies from multiple sources.
Yeah, it seems like a little bit of advice of err on the side of safety and common sense, rather than try and push the envelope a little bit and hope not to, hope that the audit or that the process falls on your side.
Yeah.
Yeah. Okay. Another question. Can you detail can you give a bit more detail on the safe harbor, i.e. if revenue drop if revenue drop requirements are met on 1 month, does safe harbor kick in the month following, even if there isn't sufficient reduction in the revenue?
Yeah, so two different things here that are available. The safe harbor provisions were only available for period 5 and 6. And so they were a way of, let's say, transitioning from that, 30% revenue decline cliff from period 4 and still allowing for a 75% subsidy in period 5 and 6. The deeming provision allows for any of the periods to basically to have your subsidy based on the revenue decline of the current month or the previous month, whichever one is biggest. And so you can be deemed to have a revenue decline and subsidy rate based on the prior month if it's better for you. And this is where, I would say I'd echo Greg's comments, which is the CRA has done a pretty darn good job with the spreadsheet that they've developed. And if you use it, it will select the proper base subsidy or wage subsidy based on the inputs, and the inputs are all of the different revenues from all of the different periods that could get you to qualify. So both the safe harbor provisions for July and August and the deeming provision for every period are captured by those CRA spreadsheets.
Yeah, Kent, if I could, just backing up, I saw a comment there about whether or not public companies might have to repay their wage subsidies if they made certain elections to get them there. And that draws out, I think, a couple points. One is the elections are there for a reason. They're legit. And if they help you get the wage subsidy, then you get the wage subsidy. And I don't think it's a reason why your subsidy could later be denied or you'd be asked to repay it. Two, interestingly, if you qualify for the CEWS, either because you've made a particular election or not, it's really comes down to the math on it, more so than the reason. There's nothing that says you can only qualify for the CEWS if your results have been impacted directly in some way by COVID itself. You don't have to justify your wage subsidy application vis-a-vis the actual pandemic. It's just based on the numbers. And I guess the last thing I'd mention is the only reason why we would know what a public company has received in a wage subsidy is because they have to make public disclosures on these things. And I don't know if they actually, I haven't looked, I don't know if they actually disclose how they came about qualifying. They might just disclose the fact that they actually received the amount in the first place. A private company, I don't think that information would become public.
Yeah. Okay, great. Thanks, Greg. Appreciate you answering that question. And last question, did we have to fill out a separate attestation form for using Jan-Feb revenue?
So it is just one of the boxes on the standard attestation form that you complete for each period. And so that is, that form should be completed one form per period. And there is a box in the middle section of elections where it doesn't specifically say January, February. It uses the words prior reference period, but that box would need to be checked and the form completed for each period.
Great, thank you. So that's it, I think, for questions. I think I've covered most of them. If someone has a question that we missed, please forward it in, and we'll make sure that we try and get answers for you. Greg, to your point earlier, this is kind of nerdy accounting stuff, but you guys should be congratulated because I don't think we've had any webinar we've had keep 30 participants after time to just.
Well, apologize for being long-winded.
No, not at all. I think this is a very critical time and a critical discussion that our member businesses are interested about. And if you can, I mean, I always put myself in the place of a small business owner trying to navigate through this stuff. Some of the larger businesses obviously have resources like yourselves, but some don't. So I think this has been a wonderful opportunity for people to get some answers and to build their knowledge base. So thank you very much for that. I guess my last comment would be make sure you do, if you're a business of any size, reach out to a tax specialist to help you prepare for this upcoming tax season, because I think it will be a challenging one for some folks. So on that note, in chamber news, we are having a virtual business after hours this Thursday. Lots of prizes available and opportunities to meet other chamber members. So please join us there if you're free. We're also hosting a free event with the mayor next week, and our virtual Wonder Woman conference is the week after that, which is a big event for us. February is a very busy event for the chamber, so please check in on our website and our events page to see what's coming up. And this, as I said, this video is recorded and will be on our, this webinar is recorded and will be on our YouTube channel very, very shortly. So on that note, I want to thank Lori and Greg for giving us their time this morning and their extra time to answer all these questions. Very generous of you both, and very generous of Baker Tilly to allow you guys to join us today. So on that note, I'll sign off and thank you all for joining, and thanks again to Lori and Greg for coming and helping us today.
Thank you for having us.
Thanks.